So you want to own an artificial intelligence data center. You've seen the headlines. You've watched Elon Musk build what some people are calling the most powerful AI supercomputer on Earth in roughly 122 days.
Elon Musk and his xAI startup have built the largest and most powerful artificial intelligence training supercomputer in the world. Elon has named this beast Colossus. It is equipped with the latest NVIDIA GPU hardware, it's liquid-cooled with vast amounts of water, and is powered by giant Tesla Megapack batteries. Elon believes that all of this combined will create the world's—
You've read about OpenAI's $500 billion infrastructure vision. You've probably thought to yourself, somewhere between your third espresso and a glance at your brokerage account, that maybe, just maybe, this is the business to be in. The dream is seductive. Rows of glowing servers, rivers of data, the backbone of the next industrial revolution humming quietly in a building you own. Rent it to Google, rent it to Anthropic. Collect billions per month while the robots do the heavy lifting. It sounds less like a business and more like a money printer with a cooling system. By the end of this video, you'll know exactly what it costs to build one, where the money actually comes from, what has already gone catastrophically wrong for people who tried this before you, and whether the numbers, when you run them honestly, actually make sense. Let's start with the illusion. Most people who fantasize about owning an artificial intelligence data center think they're buying a very large, very expensive computer room. And technically, they're not wrong. But that's a bit like saying you want to own an oil refinery because you enjoy filling up your car. The operational reality of a modern artificial intelligence data center sits somewhere between building a small power station, managing a semiconductor logistics chain, and operating a financial instrument with a depreciation schedule that would make an accountant weep. Here is the first thing that should adjust your expectations. The cooling systems in a modern artificial intelligence data center can require as much energy as the actual computing processes. You are not just building a computer, you are building a facility where roughly half the electricity bill goes to stopping the computers from melting. Energy consumption by data centers globally is projected to reach 1,198 terawatt-hours by 2025, accounting for approximately 3% of all electricity used on Earth. That is not a technology statistic. That is an infrastructure statistic, the kind that belongs next to highway systems and water treatment plants. And the economics compress everything. Owning an artificial intelligence data center is not a tech play. It is a real estate play, a power infrastructure play, a semiconductor leasing play, and a bet on a market that is growing at a compound annual growth rate of 38.1% per year toward a projected value of $1,597.1 billion by 2030. The upside is extraordinary. The execution risk is merciless. Now, let's talk about what your money actually buys at each level of this market. The entry point into artificial intelligence data center ownership is not as accessible as buying a strip mall. Forget everything you know about commercial real estate. A modest setup in this industry can cost upward of $1 million just to get the hardware running. That buys you what the industry would generously call a Tier 1 facility. For roughly $1 million to $5 million, you get a small-scale artificial intelligence compute cluster. We are talking perhaps a few hundred high-performance graphics processing units, which is the industry shorthand for the specialized chips that actually run artificial intelligence workloads. At this level, you are probably leasing space inside a co-location facility, which means someone else owns the building and the power infrastructure while you own the equipment inside. Your customers are typically startups, small research teams, and mid-sized companies that need burst compute capacity but can't justify their own infrastructure. Your revenue is measured in thousands of dollars per month. Your margins are thin because you are competing against Amazon Web Services, Microsoft Azure, and Google Cloud, which together own over 60% of global cloud infrastructure. Competing at this tier is not a business strategy. It is a hobby with a server rack. The mid-market, what we would call Tier 2, is where things get genuinely interesting and genuinely expensive. At this level, you are spending somewhere between $50 million and $300 million. You have a real facility, probably 5 to 30 megawatts of power capacity, and a meaningful cluster of high-end graphics processing units, potentially in the range of a few thousand to tens of thousands of chips. You have your own power connections, your own cooling infrastructure, and enough capacity to attract serious enterprise customers, government contracts, and potentially mid-sized artificial intelligence companies that need dedicated compute. This is the tier where you can build a real business, but it is also the tier where the operational costs become genuinely punishing. Then there is Tier 3. This is where Elon Musk is playing. This is where OpenAI is playing. And unless your net worth has at least 10 zeros, you are watching from the parking lot. A facility like xAI's Colossus in Memphis, Tennessee, which reportedly brought its initial 100,000 NVIDIA Hopper graphics processing units online in 122 days, represents a build cost that, even counting only the graphics processing units at roughly $25,000 to $40,000 each, implies a chip alone cost of $2.5 billion to $4 billion for just the first phase. A fully built 300-megawatt artificial intelligence campus, using the industry benchmark of roughly $38 million per megawatt all in, comes to approximately $11.4 billion. For the expanded version of Colossus at around 220,000 graphics processing units, the graphics processing unit cost alone approaches $5 billion to $8 billion before you have spent a single dollar on power, cooling, networking, land, construction, or the teams needed to keep it running. Colossus 2, the next planned phase, reportedly targets 555,000 NVIDIA graphics processing units, with a graphics processing unit purchase cost alone of around $18 billion. OpenAI's Stargate project, meanwhile, has announced a $500 billion multi-year commitment with an initial deployment of $100 billion, targeting around 10 gigawatts of artificial intelligence infrastructure. Using the $38 million per megawatt benchmark, 10 gigawatts implies an all-in build cost of approximately $380 billion. The $500 billion headline makes more sense when you include financing costs, site overbuilding, redundancy, chip refresh cycles, and the sheer friction of building at national infrastructure scale. These are not business investments in the traditional sense. These are geopolitical bets. Now, we get to the question that actually matters. Assuming you build the thing, where does the money come from? The naive answer is cloud computing revenue. Rent out your graphics processing unit capacity by the hour. Charge a premium for artificial intelligence workloads. Sit back and collect. That is the business model on the surface, and it is real. But the surface is not where the serious money hides. Here is the first hidden loop. The real product is not compute. The real product is scarcity. NVIDIA's most advanced graphics processing units are among the most
volume production will ship in Q4. Q4, we will have billions of dollars of Blackwell revenues, and we will ramp from there.
Supply-constrained commercial products on Earth. Companies like Anthropic and Google are not leasing Colossus capacity because they couldn't build their own facility. They're leasing it because they cannot get the hardware or the power, or both, fast enough to meet their own deployment timelines. Musk built Colossus at a reported speed that hyperscale cloud providers have not matched. That speed itself became a monetizable asset. According to reports, Anthropic agreed to lease Colossus capacity from SpaceX and xAI for approximately $1.25 billion per month. Annualized, that is $15 billion per year. The reported deal covers access to roughly 220,000 NVIDIA graphics processing units and around 300 megawatts of compute. The implied price is approximately $5,700 per graphics processing unit per month, or about $7.80 per graphics processing unit per hour. Google reportedly agreed to pay approximately $920 million per month for access to around 110,000 NVIDIA graphics processing units. That annualizes to approximately $11.04 billion per year. Google's implied price works out to roughly $8,360 per graphics processing unit per month, or about $11.50 per graphics processing unit per hour. Why does Google pay a higher per unit price than Anthropic? Possibly different hardware generations, different service guarantees, different ramp structures, or simply different negotiating leverage at different moments in time. If both leases run simultaneously at full reported rates, the combined gross revenue is approximately $2.17 billion per month, or around $26 billion per year from just two tenants. If the all-in build cost of Colossus 1 at 300 megawatts was approximately $10 billion to $12 billion, the theoretical payback period from lease revenue alone could be measured in months, not years. The practical reality is more complicated, as we will discuss shortly, but the architecture of the business is staggering. Musk has effectively constructed what the industry does not yet have a clean word for. It is part data center, part real estate investment trust, part graphics processing unit leasing company, and part geopolitical compute choke point. The second hidden loop is power arbitrage. Artificial intelligence data centers require enormous amounts of electricity, and the operators who can secure cheap, large-scale power contracts early gain a structural cost advantage that compounds over time. The gap between what it costs you to buy power wholesale and what your tenants effectively pay for it through their lease agreements represents a margin that scales with megawatts. At 300 megawatts, even a small difference in power cost per kilowatt hour translates into hundreds of millions of dollars per year in cost differential. This is why site selection in artificial intelligence data center economics is not a logistics question. It is a financial engineering question. The third loop, and this one is easy to overlook, is the depreciation and upgrade cycle itself. Graphics processing units have a commercial relevance window that has historically been measured in roughly 2 to 3 years before the next generation delivers meaningfully better performance. Operators who own the hardware and lease it out face the uncomfortable reality that their assets are depreciating toward irrelevance on a schedule that doesn't always align with their lease agreements. But there is a flip side. If you are the operator who can guarantee delivery of next-generation hardware the moment it becomes available, that upgrade optionality itself becomes a premium product. Tenants paying over $8,000 per graphics processing unit per month are not just paying for silicon. They are paying for the certainty that the operator has the supply relationships, the power capacity, and the operational discipline to keep delivering frontier compute without interruption. OpenAI understood this dynamic and built a different version of it. Rather than owning the hardware directly, OpenAI structured the Stargate project to pull financial commitment from SoftBank, Oracle, and other partners, creating a demand engine so large that it effectively compelled third parties to build infrastructure on OpenAI's behalf. When your compute demand is large enough, you don't need to own the facility. You just need to be the reason someone else built it. That is an entirely different business model, and it carries an entirely different risk profile. But here's the strange part. Despite the headline numbers that would make any investor's heart accelerate, this business has already produced some genuinely spectacular disasters. And understanding those disasters is more instructive than any of the revenue figures. The most structurally important failure story in artificial intelligence infrastructure is not a single bankruptcy. It is a pattern, and the pattern looks like this. A company raises an enormous amount of capital, commits to an enormous amount of infrastructure spending, and then discovers that the revenue ramp required to service that spending is slower, steeper, or less certain than the models suggested. The capital markets forgive a lot during expansion. They forgive almost nothing during a correction. The clearest early-era case study is Exodus Communications. In the late 1990s and very early 2000s, Exodus built what was then considered a revolutionary internet data center business. At its peak, it operated over 40 large data centers across the United States and Europe. The business logic was almost identical to what artificial intelligence data center operators articulate today. Build the fastest, most capable infrastructure. Charge a premium for access. Let the internet economy's growth rate do the rest. Exodus raised billions and signed what looked like transformative customer contracts. But the company was burning cash at a rate that required revenue growth to remain perfectly calibrated to an extremely aggressive schedule. When the dot-com collapse hit, customer contracts were canceled or restructured. Revenue fell sharply. The company filed for bankruptcy in September of 2001 with approximately $3.2 billion in debt. The physical infrastructure was real. The buildings were real. The power connections were real. What failed was the assumption that the revenue required to service the debt would materialize on time. The second case study is more recent and more directly relevant. In 2023 and 2024, the explosive growth of artificial intelligence demand created a class of companies that acquired NVIDIA graphics processing units on credit or through complicated financing structures, then leased them out to artificial intelligence startups. When the graphics processing unit supply began to loosen slightly and competition among cloud providers intensified, pricing pressure on leased compute started to compress margins. Some smaller operators who had acquired hardware on short-term financing found themselves caught between falling lease rates and fixed debt service costs. The companies that failed were not incompetent. They were simply operating a business whose unit economics depended on supply remaining constrained for longer than it did. CoreWeave, to use a specific example, avoided that fate by securing extremely large and long-term contracts, including a reported commitment from Microsoft worth billions of dollars, which gave it the revenue certainty needed to support its debt load. Companies that didn't secure equivalent anchor contracts found themselves in a much more difficult position. The third structural risk is regulatory and geopolitical. The United States government has taken an increasingly active interest in where artificial intelligence infrastructure is built, who owns it, and which chips are allowed to cross which borders. NVIDIA's most advanced graphics processing units have been subject to United States export restrictions that prevent their sale to certain countries, most prominently China. For operators whose business models assumed global customer access, those restrictions represented a direct revenue haircut. For companies that had already committed capital to build capacity intended for international customers, the regulatory shift created stranded assets. The broader risk is that artificial intelligence infrastructure is now explicitly part of national security policy in multiple countries. That means the operating environment for artificial intelligence data centers is no longer purely commercial. It is subject to executive orders, export controls, foreign investment review processes, and congressional oversight. Building a multi-billion-dollar facility that depends on a stable geopolitical environment to remain commercially viable is, to put it gently, a concentrated bet on something that has historically been unreliable. There is also the environmental pressure, which is moving from background noise to direct operating cost. Artificial intelligence data centers by 2025 will account for approximately 3% of global electricity consumption. Regulatory pressure on that footprint is increasing. Many artificial intelligence data center operators are accelerating their transition to renewable energy contracts, which adds capital and contractual complexity. The companies that don't manage this well will face both regulatory exposure and reputational risk with major enterprise customers who have their own sustainability commitments. Now, time to pull it all together and answer the actual question. How much money do you make if you do this right? Let's run the numbers across two realistic scenarios. Scenario 1 is your Tier 2 operation. You spend $200 million to build a facility with approximately 20 megawatts of power capacity and a meaningful cluster of high-end graphics processing units. Your annual operating costs include power, cooling, networking, staff, maintenance, and hardware refresh. A reasonable estimate for a 20-megawatt artificial intelligence facility's annual operating cost is somewhere between $30 million and $50 million. Your gross revenue, assuming you can achieve strong utilization rates and lease capacity at competitive market rates, might reach $60 million to $90 million per year. Your net profit after operating costs falls somewhere between $10 million and $40 million annually. At the midpoint, call it $25 million per year. At that rate, your $200 million initial investment has a payback period of roughly 8 years. For comparison, that same $200 million invested in an index fund tracking the broad United States equity market at a historical average annual return of roughly 8 to 10% would grow to between $429 million and $518 million over 8 years. So the honest question is not just whether you can make money from an artificial intelligence data center. It is whether you can make more than you would make by doing nothing. The answer is yes, potentially, if you clear 3 hurdles. First, you need to secure anchor tenants before you build, not after. An empty data center is an extraordinarily expensive monument to optimism. Second, you need a power supply contract that insulates you from wholesale price volatility. Third, you need to build in a hardware refresh cadence that keeps your capacity commercially relevant through at least 2 graphics processing unit generations. If you clear all 3, the unit economics can genuinely outperform passive alternatives. Scenario 2 is the Tier 3 model, and this is where the numbers become genuinely disorienting. Using the reported Colossus 1 figures as a benchmark, a 300-megawatt artificial intelligence campus costs approximately $10 billion to $12 billion to build. Annual operating costs at that scale are enormous. Power alone at 300 megawatts, running continuously at commercial electricity rates, can cost hundreds of millions of dollars per year. Staff, networking, maintenance, and hardware management add hundreds of millions more. Let's use a conservative estimate of $1.5 billion per year in total operating costs for a facility of that scale. Against that, if the reported lease figures hold, the combined Anthropic and Google leases from Colossus capacity imply approximately $26 billion per year in gross lease revenue. Subtract $1.5 billion in operating costs and you have approximately $24.5 billion in annual gross profit before hardware depreciation, debt service, and taxes. Even accounting for aggressive hardware depreciation on $20 billion plus of graphics processing units, the theoretical cash generation at full lease utilization is extraordinary. The payback period, in theory, is under 1 year. But here is what the model assumes that reality does not guarantee. It assumes 100% lease utilization. It assumes both tenants pay full rate for the full term. It assumes the hardware remains commercially relevant long enough to extract full contract value. It assumes no regulatory disruption. It assumes power costs don't spike. And it assumes that Musk continues to have the supply chain relationships needed to keep delivering frontier NVIDIA hardware, which is itself a geopolitical variable. The same $200 billion or $10 billion invested passively would, at 10% annual returns, become approximately $25.9 billion over 10 years. So the Tier 3 model does theoretically outperform passive investment, but only if everything goes right, the contracts hold, the hardware stays relevant, and the regulatory environment remains stable. Those are three very large assumptions. The deeper truth about artificial intelligence data center economics is that it has created a new category of infrastructure asset that does not fit cleanly into any existing investment framework. It is not real estate, though it shares real estate's capital intensity and location dependency. It is not cloud computing, though it resembles it from the outside. It is not manufacturing, though it involves supply chains and hardware that depreciates. It is something closer to a toll road for the attention of machines, built during a gold rush, priced at a premium that reflects not just current demand, but the collective panic of an industry that is terrified of being left without enough compute. OpenAI described it plainly with the Stargate project. The first commitment is $100 billion. The full vision is $500 billion. The implied
announcing the formation of Stargate. So put that name down in your books, because I think you're going to hear a lot about it in the future. A new American company that will invest $500 billion at least in AI infrastructure in the United States and very, very quickly, moving very rapidly, creating over 100,000 American jobs almost immediately. This
all-in build cost for 10 gigawatts of artificial intelligence infrastructure at the $38 million per megawatt benchmark is $380 billion. These are numbers that are no longer measured in business terms. They are measured in the terms of national industrial policy. Musk is trying to own the toll booth. OpenAI is trying to reserve the entire highway before anyone else can drive on it. Google and Anthropic are paying both of them for access to roads they should probably have built themselves. And in that one sentence, you have the entire economic structure of the artificial intelligence data center industry in 2024. Everyone is paying someone else for access to compute they don't own. In a race to build compute they can't build fast enough to serve a market that is growing faster than anyone can accurately model. The business is real. The demand is real. The margins, when they exist, are extraordinary. But the execution risk, the capital intensity, the depreciation schedule, the regulatory exposure, and the sheer speed at which this market moves mean that owning an artificial intelligence data center is less like owning a business and more like owning a very expensive seat at a table where the rules change every 18 months and the other players have resources that make yours look modest. Sure, you have the money for it. But in this particular game, having money is just the entry fee. The actual advantage goes to whoever controls the power, the chips, and the contracts in that order. And if you find yourself owning all three, well, then you're not really running a data center anymore. You're running a small country with better cooling systems.